Welcome to the deep dive. So today we're deliberately sidestepping the usual stuff. No charts, no complex strategies.
Right.
Instead, we're tackling something maybe far more critical and definitely more painful for many traders, whether it's forex, gold, crypto, doesn't matter. We're talking about the psychology of failure.
Exactly. And for this deep dive, we're not just theorizing. We're really digging into um, some raw lived experience. We've got insights from a trader who went through some massive setbacks,
Yeah, huge ones.
including, having to return home from the U.S. after a major failure back in 2016. So our mission today is pretty clear, I think.
Okay.
I want to look past the trading tactics and really uncover those fundamental human drivers of loss.
Mm.
And more importantly, identify the practical, specific steps you need for emotional control, for, long-term success.
Okay, let's unpack that then, because the source material, it jumps right in, doesn't it? It argues the real battle isn't technical at all. It's all in your head.
It is. It's this deep conflict. The trader suggests our basic human psychological makeup, the stuff we're born with, has these traits that just clash with what trading demands.
Like what specifically?
Well, four main things they point out. First, you've got that natural competitiveness, right? Wanting to win.
Mm-hmm.
Second, a tendency towards conflict, maybe even aggression in decision-making.
Mm.
Third, like it or not, there's a bit of a gambler in most of us.
Yeah.
And fourth, maybe the most dangerous one, is that pervasive desire to get rich without really putting in the hard graft. The source calls it wanting to sit comfortably and eat gold.
Sit comfortably and eat gold. I like that. So these inherent flaws, they make us vulnerable. Does that mean the market systems, the platforms, are kind of rigged against us from the start?
Well, that's a really interesting point the trader makes. They argue it's not rigged in a, secret manipulation sense necessarily, but rigged because the system knows how to exploit us. The companies creating these platforms, the brokers, the market makers, their business model is often built around profiting from these exact human weaknesses.
So they're like the house in Vegas.
Exactly. They are the house. They design things, generate business ideas, create systems specifically geared towards transferring money from the masses, from the retail traders, to them.
Wow.
And they don't need to take huge amounts from individuals. They just need a tiny slice from millions of people. Take $1 from a million traders. That's $1 million right there.
Right. Because most people walk in with that flawed psychology. So if greed and these other traits are the fuel, what did the trader identify as the absolute rock bottom reason for failure before strategy even enters the picture?
It's almost disappointingly simple. It's a lack of, or just insufficient basic knowledge, foundational knowledge.
The boring stuff.
Precisely. People skip the fundamentals because they want the exciting strategies, the secrets.
Yeah.
The trader uses the analogy of building a house. If you neglect the foundation, if it's weak or non-existent, you can build the most amazing structure on fancy indicators, complex algorithms, whatever.
It's coming down.
It's guaranteed to collapse. The foundation has to be solid first.
Can you give an example? Like, what's a foundational thing people gloss over?
Oh, absolutely. Think about basic risk management, like position sizing.
Okay.
People jump into learning chart patterns, trend lines, but they completely ignore the simple math of how much capital to risk on one single trade relative to their total account size.
Yeah, that seems critical.
It is. If you don't get that right, or you ignore leverage properly, the first time the market makes a significant move against you, that weak foundation just crumbles. Fear kicks in instantly, and boom, emotional decisions, catastrophic losses.
That makes total sense. Okay, so let's shift to this idea of intellectual gambling. The trader differentiates between just random betting and, well, skillful trading using this concept. They use a couple of card game analogies.
They do, and it's quite insightful. Trading, investing, it inherently has that speculative element, right? Not a guaranteed salary.
Sure.
But the key difference is how you approach it. Are you gambling, or are you applying intellect? The first game analogy is Tai Shu.
Which is basically like big, small, right? A game of pure chance.
Exactly. Betting on odds or evens, red or black. This represents trading purely on luck, maybe gut feeling, with no real analysis or edge.
Okay.
When you trade like that, especially on less reputable platforms, you're playing right into the broker's hands if they're dishonest. They can potentially manipulate things because you're relying on randomness, the outcome. Almost guaranteed failure over time. The house always wins against pure chance.
Right. The odds are literally stacked against you. But the other game is Tin Lin, going forward.
Yes, Tin Lin. Now, this is a card game that requires serious skill, strategy, reading your opponents.
Ah, okay. More like poker, maybe?
Kind of, yeah. It represents trading, where success hinges on technique, on solid knowledge, on hard-won experience, and crucially, on understanding market dynamics and, yes, the psychology of the other players.
So you're competing against other traders, not just the platform.
Precisely. On a good regulated platform, it's you against the market, against other minds applying their skills. Your intellectual application, your discipline, your risk management, that's what determines success. It's the only path that actually offers a chance of sustainable results.
But that path, the intellectual one, demands rejecting the lure of fast money, and that seems incredibly hard, especially for people who come to trading out of, say, desperation.
It's the biggest trap. The source points out that real, sustainable wealth building, like major innovations or businesses, it takes time. Decades, often. 10, 20, 30 years.
Right.
So if you're drawn to trading because you're already deep in debt or you desperately need cash now, you are the prime candidate for making high-risk, emotionally charged decisions. You're not looking for a strategy, you're looking for a lottery ticket.
And the market doesn't hand those out reliably. So talk about that first win. The trader mentions turning like $5,000 into $10,000 relatively quickly. That initial success, what did it do psychologically?
It was poison. Pure poison. That early, maybe even lucky, win triggered what they call the casino mindset. Profound, uncontrollable greed just took over.
So discipline just vanished.
Completely. Yeah. Gone. They weren't happy with doubling their money. Suddenly they needed $50,000, then $100,000.
Yeah.
Right now. It felt easy. And because it felt easy, they stopped prospecting the risk, stopped following any rules.
And this directly led to that big crash in 2015, 2016.
Directly. That overconfidence, fueled by initial success and greed, was the fuse.
And it wasn't just their own money they lost in the end, right? They brought in outside capital.
That's right. Things escalated. They raised significant funds, mentioned an Australian investor, some Vietnamese partners too. The total combined loss ended up being around $20,000. A huge hit, personally and professionally.
And what's really fascinating is how they tried to manage their own psychology during that time, knowing they were susceptible. They tried splitting up the money.
Yeah, it's quite revealing about the mental games we play. They knew they were getting emotional with larger sums. So they thought, okay, instead of trading one $10,000 account, I'll split it into, say, 5 separate $2,000 accounts.
The thinking being smaller numbers feel less scary.
Exactly. They hoped fragmenting it would somehow dilute the psychological weight, reduce the perceived risk for each trade decision.
Did it work?
Not a chance.
Ah.
They discovered the mind is actually pretty smart at keeping track.
Figures.
Yeah. Even though they saw 5 smaller accounts on the screen, their brain was constantly adding it up, calculating the total risk exposure across the whole $10,000. That 5% risk was still 5% of the total. The stress didn't go away. It just got more complicated.
And then technology failed them too. There was this copy trading setup.
Yes. Running from about 2013 to 2015, this added another layer of disaster. The lesson learned there was about complexity and fragility.
How so?
Well, when you have multiple accounts linked, maybe automated to some degree, what happens during a sudden market shock, like unexpected news, or even just a system glitch?
You can't react fast enough.
Exactly. They found they couldn't manage the fallout across all the connected accounts simultaneously. One bad signal, one piece of news, one system error, and it could instantly trigger losses across 10 accounts at the same time. Wiped out.
Wow, synchronized failure. That's brutal.
It is. If your system involves that kind of complexity, you absolutely have to be prepared for and capable of managing that risk of everything going wrong at once. Most traders, honestly, aren't.
It sounds like an absolutely devastating period. It must have forced a complete rethink. Before we get into the specific strategy they built after this, what was the first step they took away from the charts to just recover?
That's key. They realized you can't fix a psychological wound with just a better trading strategy. After hitting rock bottom, they didn't quit trading permanently, but they took a significant, deliberate break.
How long?
About 6 months. Completely away from the markets. They did completely unrelated things, learned guitar, took up gardening, stuff to just reset the brain.
So it wasn't avoidance, it was active mental repair.
Precisely. Cooling down that compulsive urge to jump back in and win it back, building a mental buffer. They only returned when they felt genuinely repaired and ready to focus purely on knowledge and discipline, not revenge.
You have to heal the person first. Okay, that's huge. So let's get practical. The methodology they developed to control fear and greed. Step 1, the daily income test. Why is this so fundamental?
Because it forces brutal honesty about your financial reality. You have to calculate your true daily disposable income.
Meaning?
Your total income, salary, passive streams, whatever, minus all your essential living costs. Rent, mortgage, food, utilities, transport, loan payments, even potentially things like cigarettes or coffee habits if they're fixed costs. Everything.
So what's genuinely left over each day?
Yes. That small amount, maybe $10, maybe $50, maybe more. That represents the maximum amount you can afford to lose psychologically on any given day without it causing immediate financial stress or panic.
Okay. And step 2 uses that number. The readiness assessment. This sounds pretty harsh.
It is, and it's designed to be. This is especially for newer traders.
Yeah.
You take that daily disposable income number, let's say it's just $10 a day.
Right.
Now you compare that to a standard sensible risk level, like 1% risk per trade on your intended trading capital.
Yeah.
If that 1% risk amount is equal to or more than your $10 daily disposable income,
Now what?
then the source is very clear. You are not financially or psychologically ready to trade seriously with real money yet.
Wow. Even if you have, say, $1,000 in the trading account, why is losing just $10 so triggering?
Because that $10 isn't just an abstract number on a screen. It represents a tangible chunk of the money you need for your immediate life, for daily survival or basic comforts.
Ah, okay. It feels real.
It feels incredibly real. Losing it instantly triggers regret, fear, and that powerful destructive urge to make it back immediately. That's when strategy goes out the window and you start gambling recklessly.
So what should you do instead if you fall into that category?
Use that money for education first. Buy books, take courses, or practice risk management principles on what are called cent accounts.
Cent accounts. What are those exactly?
They're special accounts some brokers offer where your deposit is displayed in cents, not dollars. So if you deposit $10, it shows up as 1,000 cents in the account.
Ah, so it scales everything up visually.
Right. It lets you trade standard lot sizes and practice realistic risk management, like risking only 10 cents, which looks like 10 units, per trade, but with very, very small actual capital at risk. It's great for building muscle memory without the financial fear.
Got it. Okay, so assuming a trader passes that test, they can comfortably absorb the risk of, say, a 1% loss daily. How do they stop greed creeping back in later? This leads to step 3, the rule of level progression.
Yes, and this is the core of the long-term emotional control strategy. It's a rigid, time-based system. Level 1 means you trade only at 1% risk per trade, period.
For how long?
For a significant duration. Minimum 6 months, ideally a full year. Non-negotiable. Not 1.1%, not 1.5%, just 1%.
You're deliberately capping your potential gains there. What's the psychological objective?
The objective isn't profit maximization at this stage. It's neurological conditioning. You are training your brain, your eyes, your nervous system to see a 1% fluctuation, win or loss, as completely normal, mundane even.
Like building a mental callus.
Exactly. You want to reach the point where a 1% dip doesn't even register emotionally. No panic, no excitement, just data. It's about neutralizing the emotional sting through sheer repetition over time at a low-risk level.
Okay, so a year of 1% risk. Then what? Level 2?
Only if level 1 has produced consistent results. The source suggests maybe aiming for something like 30% annual profit as a benchmark of system validity, not just luck. And your daily income situation must still comfortably absorb the higher risk level. If both conditions are met, then you can consider moving to level 2, which might be 2% risk per trade.
Still very controlled.
Very.
Ah.
And again, you stay at level 2 for another extended period, maybe another year, until that feels completely normal too.
What about the profits generated during level 1? This part was interesting.
Crucial psychological safeguard.
Yeah.
Any profits made during level 1, they must be moved out of the trading account into a completely separate account. Savings, investment, whatever. But not kept in the trading pool and definitely not spent on luxuries.
Why is that so important?
It prevents the easy money mindset from taking root again. If you start spending profits early on, it reinforces the idea that trading is a quick cash machine. That destroys discipline faster than anything. You risk level jumping, getting greedy, and undoing all the psychological conditioning. The focus has to remain on consistency and process, not the immediate rewards.
It really emphasizes the time commitment. The trader mentioned spending at least 2 years just perfecting one specific strategy, like supply demand. It's not about hopping between systems.
Absolutely not. Success wasn't about finding some mythical holy grail indicator. It was about deep mastery of core concepts, trend lines, price action, support resistance, and then integrating the useful parts into a single, personalized, highly refined system.
Like Bruce Lee's philosophy.
Exactly like Bruce Lee's Jeet Kune do. Absorb what is useful from different styles, Discard what is useless, add what is specifically your own. You build your system through deep practice and integration, not by searching for someone else's secret.
It's fascinating. We started this deep dive, thinking about markets and money, but it really all comes back to psychology. Patience, discipline, self-awareness. The source seems to argue success is maybe 80% psychology, 20% skill.
Easily. The technical skill is necessary, of course, but it's useless without the mental fortitude built through this kind of slow, deliberate, level-by-level progression.
And remembering that need for a mental break when things go wrong is vital too.
Absolutely. Failure will happen. Setbacks are part of the journey. The trader's experience shows you have to recognize when you're emotionally compromised. Don't just quit, but take that hiatus 6 months, a year, whatever you need to heal, learn, and return stronger, armed with knowledge and that rigorous system for control.
So wrapping this up, what's the final takeaway for someone listening, trying to navigate these psychological minefields?
I think the most powerful message is about self-mastery. Ultimately, the highest level of trading isn't about finding the perfect mentor or signal service. It's about becoming self-sufficient, meaning you can't truly rely on anyone else for your long-term success. Not the person sharing this advice, not a guru, not your trading buddy. What happens if they disappear? Or if their system stops working?
You're left exposed.
Completely.
Yeah.
Your enduring success hinges entirely on your ability to build your own fishing pole, your own robust system for analysis, risk management, and crucially, emotional control, depending on others to give you the fish every day. That's the riskiest trade of all. That independence, that self-mastery, that's the only real profit that lasts.